Welcome to the daily update, where I'll go over the action in the market for Tuesday, September 12th, and then we'll see how things are looking for Wednesday, September 13th. We're back to a mixed technical picture right now. We looked a little bit more positive on Monday. We actually, in the short term, switched to positive. Well, we had a down day on Tuesday, and we're back to more of a mixed picture now. Everybody is waiting for the CPI to be released. It's all about inflation and interest rates, as I say pretty much every day in the videos. And this is the big inflation report to see where we go from here. There are some positive things that we can look at. There are some negative things that we need to be aware of. But at the same time, the market is really indecisive and we're not trending right now. And so there's a case to be made for either side. And so maybe, just maybe, something will get decided in Wednesday's session. But what happens a lot of times, we have a build up to an economic report. It comes out and we're kind of where we were before. So that's always something that's rather frustrating. And then the market still lacks conviction. So we still look under the surface. We still look at what's going on and then develop our plan based on what the technicals and what the pictures are actually telling us right now. Okay, I have completed 2 of the 3 1-hour sessions. I did the first one on Monday, where I talked about my approach to technical analysis. Then on Tuesday, I talked about strategies. I'll be doing the 3rd hour on Wednesday from noon to 1 p.m. Eastern time. And I'll talk about support and resistance. I'll also use some different charts. I am doing this on Zoom. There is a link that's posted in the community tab. You might have to scroll down a little bit to get to that if you want to join it. I'm also recording this. So, and then once I get done with all of the recordings, I'll upload them kind of together so they're in the same basic place. I think that's easier to view them that way. So feel free to check that out if that's something that you would like to do. All right, let's go back and talk about what happened. We had a lower open. We opened below the daily pivot at 44.82, and then we fell down below S1 at 44.73. We did climb back. We got back above the daily pivot, but we hit resistance at the unchanged level. That's that built-in support or resistance level that we see pretty much every day. After that, prices fell back below the daily pivot. We fell back below S1. We went down to S2 at 44.59, and we closed slightly off of the low, which was slightly above S2. We were down 0.57% on above average volume. Now, not very much. We're just barely above the moving average, but volume is picking up a little bit. We'll have to see after the CPI comes out in Wednesday's session, then the PPI, the economic reports. You would think now that summer is kind of leaving us and vacations and holidays and so forth, that maybe volume will start to pick up. But a lot of people are aware that September is a weak month and most people want to buy low and sell high. And so they might be sitting out on the sidelines while this is happening. The technicals, as I said, are back to mixed now. You could make a case for either side, and I'll go through some charts to show you that. But it's about inflation and interest rates, and it's all about CPI in Wednesday's session. Some comments. We fell back below the 50-day simple moving average with the S&P. We were able to climb above it on Monday. We're back below it on Tuesday. The mega caps underperformed. They outperformed on Monday. They underperformed on Tuesday. And then we're wondering, is there going to be a new scenario that develops? The one that we've been working on for the last week, a couple of weeks actually, is the economy is stronger than expected, and we were seeing some economic reports coming out to suggest maybe the Fed will keep rates higher for longer and possibly even have to raise rates. Then we went through a period of time where the reports were weaker than expected, and that's when we saw some support in the market and actually moved up higher. Now we're kind of shifting back. At least we didn't really get any economic reports, but the ones that we got last week were stronger than expected, and now that's putting some pressure on stocks. We're also concerned about the Chinese economy because so many businesses in the S&P do business with China, and oil is going back up again, and that puts some pressure on stocks. Where it was down in Monday's session, it was up in Tuesday's session. After the CPI comes out, is there going to be some kind of a new scenario that starts to come forth? The dollar was down and interest rates were down, not by very much, but still, this should have given some support to stocks. Now, in one way, you can say, well, we still had a down day anyway. But on the other hand, maybe it could have been worse than it was, except for the fact that the dollar and interest rates were down. The yield curves that we follow are still inverted. Sentiment really didn't change. It came in at 51. We're positive, but we're leaning a little bit more towards that neutral side. And our trend, it's still positive. The green line's on top, but where it went up after Monday, now it came down after Tuesday. The ADX itself is below its moving average and below 20. So we're still in a non-trending environment. I've changed our bias now to mixed because we're really at a tipping point still, whether we're going to go up or down from here. And our momentum is also at mixed. The economic reports, I said we didn't get any reports on Tuesday. There was one, not real influential, but we did get the NFIB Small Business Optimism Index. It wasn't on the calendar that I usually look at to come up with my list of what's happening. It came in at 91.3, down from the 91.9 that we had last time. Here's a chart showing that it is decreasing a little bit, but it is recuperating from lower readings that it had recently. And then this is a chart, and I misspoke a little bit in yesterday's video. This is put out by RenMac, and I found this on Twitter. It was used in the video over the weekend by Chris Schiavocco from Schiavocco Capital, a video that I would highly recommend. And the research in this suggests that if we go above 4.02% with the 10-year yield, that's when it's going to start really having more of an impact on stocks with their earnings and really putting some more pressure on things. And I said that we were below that level. Well, we're actually a little bit above it. So here I have the current reading as of the close on Tuesday. We're at 4.26%. So we're a little bit above that 4.02%. So we're kind of doing some damage according to this research. So we'll keep an eye on this and see how things play out. Looking at the intraday chart where we did move a little bit lower, we did gap down to S1. And because the daily ranges have not been very wide the last few days, it doesn't take much for us to hit the either R levels to the upside or the S levels to the downside. We came down quickly to S1 and just chopped sideways. And after the open, to see it going sideways, that means there's quite a lot of indecisiveness right now. If we see gyration during the day, it's usually at the open. Then we drop down below S1, and then we were able to come back up, get above the daily pivot. Boom, we hit the unchanged level, and then spent the afternoon going down all the way to S2, and then we bounced up a little bit off of that going into the close. Keeping an eye on growth to value for the S&P, it's showing some weakness now. It underperformed, and that's more negative for the market. Then looking at the growth to value ratio, more on a closing basis, we were pretty much sideways. We're still in a longer term uptrend. The blue line's above the red line, but we've been chopping sideways since the middle part of March to early part of April. So we're not seeing an awful lot of strength there. Keeping an eye on the VIX as well. Looking at the average, that's the blue line. Historically, what has happened is the VIX goes up until about the middle to latter part of October. We're wondering, is that going to follow through this time? The red line is where we're at with the VIX currently. And then keeping an eye on the daily chart of the VIX, where we ticked up a little bit with the line chart and the bar chart. We're still at very low levels overall with this. And we're showing, at least in Tuesday's session, how volatility ticked down just a little bit. It'll probably pick up after we start getting some economic reports that come out. And this is also a bit of a concern, the 5-period simple moving average or the equity put call ratio. It's going back up and now giving us an extreme reading. So that's negative, and the fact that it's going up. Now, the fact that we're above this 0.8 level, that is often suggesting some kind of a change is coming, because we get an extreme reading and then we typically will start to go back down. But we could still go higher from here. So that's one thing to be concerned about. Excuse me. And then also, I don't know why we're looking at the VIX of the VIX again here. And I'm hitting the wrong button. That's the problem. Okay, then looking at the equity put call ratio, longer term, it's still going up. It's trying to roll over a little bit as the VIX has been at more of a lower level, but it hasn't been all that convincing yet longer term. For it to be more positive, we want to see this continue to go back down. Looking at the advanced decline ratio, we're pretty much flat based on price and volume, but we're still above the moving average. So longer term, it's more positive. The new highs, new lows, we're also going sideways right now. We saw a little bit more new lows being generated than new highs, but our 5 period is turning down just a little bit, but sideways, and our 10 period is also going sideways. We're again kind of mixed here with the advanced decline ratio. The blue line is just right about at the midpoint, and the red line is just underneath that. Accumulation distribution, it was looking a little bit better after Monday, but we're still below the moving average. We want to see this go above the red line and stay above the red line for the smart money to show that they're actually getting in and buying, and they're just kind of waiting too right now. The Chaikin money flow, it had been showing some improvement, but then in Tuesday's session, it showed some more weakness. So this is negative. The ratio between risk on and risk off, it was down just a little bit, where we're seeing some weakness in this area. We're not trending according to our intermediate term ADX chart. We're below the moving average and declining. The green line is on top, so we would default to positive, but it's also declining now as the red line ticked back up, and seeing almost that same thing in the short term. Not trending, default to positive, but the green line is coming down. Our daily chart, we were able to get slightly above the 50-day moving average on Monday, while we dropped below it on Tuesday. Now we're below the moving average again and below this pivot point. We did tick up a little bit with the volume, but you can see where we've been trailing off with the volume overall. So the fact that we're at a little bit above average isn't all that convincing, because the moving average has been coming down. The stochastics, we're declining, but still kind of positive in the short term. We're pretty much flat, but slightly positive in the intermediate term, and we're flat to slightly positive in the long term. With our force index, we were able to get above zero on Monday, while we dropped below zero on Tuesday. Our 20 period double and triple exponential moving averages, we're right on top of both of them currently, and we're a little bit below the 50 period double and triple exponential moving average study. We'll have to see where we go from here, whether we break more to the downside or start to show some recovery or continue to chop sideways. The go no-go system is still pretty much negative, and we're right back at the midpoint with our highest high, lowest low values. So that's, again, suggesting a real mixed environment. The TTM squeeze, though, is still positive. It has the lighter shade of blue bars here, and it is going up. Where the balance of power is slightly above the dashed line, the midpoint, and it did turn up even on a slight down day. But when you look at the bullish percent index, we're still above 50. That's positive, but we are declining. That's negative. The McClellan oscillator for the S&P, it had come back slightly above zero on Monday. Well, we dropped back below zero on Tuesday. So our summation index based on price continues to decline, but we're starting to turn up a little bit based on volume. Sometimes this gives us a little bit of a leeway. The top part of this chart and the bottom part of this chart are calculated completely different. They're two separate indicators. We just use them together to get an overall picture. When we look at the NYSE McClellan oscillator, we're still below zero and tick down, so that's more negative. So the summation index for the NYSE based on price and volume continue to decline. We have switched over to negative with the Elders Impulse system, where we had been back to positive after Monday's session. And the mass index, it's kind of confused right now too. As I've been pointing out, when this was really going up and potentially getting ready to give us a signal, that's when the S&P was going down. We crossed above the red dash line. We got almost up to the blue line, and then we started to turn and come down. Well, we were still going up with the mass index as the S&P was going back up. So that's leaving us a little bit confused right now as to what's going to happen going forward, because this indicator tries to measure a reversal, that we've been moving in one direction. This pops a signal, and then it looks for things to change and go the other way. But a change from what? We can look at the negative side of this and the positive side and not really come to a conclusion. Looking at the PMO, the price momentum oscillator, we're going sideways. We're still hanging in there positive based on price, but we're rolling over, however, just barely positive based on volume. With our PMO studies, we ticked down just a little bit with the PMOs that are rising. We saw a bit of an improvement with the buy signals, but we're declining with the PMOs that are above zero. Again, a real mixed picture. We're turning back up just a little bit with the Swenlin trading oscillator, but we're negative because we're below zero. So the fact that this is turning up, that's good, but the fact that we're below zero, that's negative. The NYSE bullish percent index is now dropping a little bit more below 50, and that's more negative. Where the NASDAQ 100 BPI, it did pretty well after Monday. Well, it turned down after Tuesday, but it's still above 50. We're still inside the Ichimoku cloud, wondering, are we going to break to the upside or break down below the cloud? And then our oscillators are kind of all over the place. We're still positive with the slope. We're starting to roll over with the TSI. We're looking negative with the MACD, the PPO, and the PMO, where the TRIX is starting to look more negative, but the KST is still staying positive. And then looking at our moving average study, both for the simple moving average and the exponential moving average, we're coming back down to the exponential moving average, but we're still above the simple moving average. So short term, we would still default slightly to the positive side. But when we look at the 50-period moving average, we're back down below the simple moving average, but we're still above the exponential moving average. So that would be more neutral. The Bollinger Bands, just a little bit above the midpoint where we were getting back above that. Now we're starting to come back down. We're just about at the midpoint to a little bit below with our standard deviations chart, again, showing more of a mixed environment. And you can see the purple, the channels here are pretty much going sideways. And that's been more indicative of a trendless environment. And we're coming back down into this mini rainbow with our 20-period simple moving average of the open, high, low closes. We were able to break above that. Now we're coming back down into it right now. Longer term, and in my opinion, more influential, the parabolic SAR is still negative with the dots on top. We get a good solid up move, and that might change, but it hasn't changed to this point. The MACD longer term is continuing to show that we're negative. The Heiken Ashi, it was looking a little bit better after Monday. Now it's gone back to more of a doji with a negative slant. Where the Kigi chart continues to be positive, the black line is pointing up. And then the Renko continues to be positive, and the 3-line break is positive. So again, we're seeing some mixed pictures here. The equal weight to S&P 500 ratio, it declined just a little bit since the mega caps didn't have a really good day. But overall, the big stocks are outperforming the smaller stocks. And dealing with the Dow, we're still below the moving average. We're still below the pivot point. So that it's just really suggesting an indecisive market. Where the diamonds, though, still remain positive with a green bar. The NASDAQ 100, it was able to get back above this previous high, the red line that you see here, but now we're back down to the red line, and we're back down to the 50-period moving average. Where the Qs were positive after Monday, they switched back to negative after Tuesday. And our momentum, it's still positive, but starting to roll over. The NASDAQ was able to get above the pivot point and the 50-day moving average. Now it dropped below both of those on Tuesday. And we're still dealing with the 61.8% retracement level for the NASDAQ. We were able to get slightly above it on Monday. We've dropped back down below it on Tuesday. On the positive side, the FANG index, which was down over 1.5%, it's still above its 50-day moving average and still in a longer-term uptrend. The small caps still really having some problems. We're still above this S1 level, but we're below the 50 and 200-day moving averages. The Russell 2000, we're more negative with the RSI because we're below 50. We fell below this support/resistance level, but we're still above the 200-day moving average on this index. but the MACD is now rolling over and looking more negative. The small caps still remain negative for the Elders Impulse system, and the small caps continue to underperform the S&P longer term. The mid caps still remain in between the 50 and 200-day moving averages and are chopping sideways, where the mid caps remain negative for the Elders Impulse system. And we did see a decline when we look at mid cap growth versus mid cap value. Or longer term, we're still in an uptrend, but we've been really chopping sideways for quite a while. And looking at Dow theory, where the Dow is hanging in there okay, but we're seeing some more weakness with the transports, and we saw a little bit of a bounce up with the utilities. And then the transports are continuing to underperform the Dow. We want to see this turn and go back up before we're more positive. If we turn more negative, we're likely to see this ratio continue to fall. And then the Dow is outperforming the transports, which is kind of the opposite of what we want to see in a positive environment. Looking at the 10-year bond yield, where we did tick down slightly with the 10-year, and then looking at Tom Bowley's research, where real estate tends to be weak in the month of September, industrials tend to do better. We're in the mid part of the month now, where if we're going to see some kind of a bounce, it would probably be happening about now. But please be aware that as we go throughout the end of the month, that's when we tend to see some more weakness. So what's our outlook for Wednesday? Still dealing with earnings reports, even though it's not as heavy as it had been. The technicals are mixed and we're not trending. And we will get the weekly MBA mortgage applications index, and we'll get the CPI. That's going to be the big one. And then keeping an eye on the geopolitical events, but it's all about interest rates, inflation, CPI, and how the market's going to react to that and see if anything can get decided. Here's the updated economic calendar for the week. We will get PPI on Thursday, and then we're going to get a slew of information again on Friday. The Stock Traders Almanac statistics for September 13th, we are positive across the board, going back to January of 2001, and we're also in options expiration, where we tend to have more of an upward bias than downward bias. We will be on the 9th trading day of the month, where we look at the green dashed line, where it tends to be fairly well. And then looking at this other measurement, we're on the 13th of September, where historically that has been positive, going from 1950 up to 2022. And then longer term here, we're looking at the NASDAQ, where we're coming into the mid part of the month, where we might see some kind of a bounce. And we might see a little bit of a bounce with the S&P too, but be aware that there's some weakness that historically has developed longer term, especially when we get into the end of the month, where September tends to not be a good month for the market. It's the worst month of the year, being only up 33.3% of the time. So our scenario is not going with the down one right now because we're not trending and we're mixed, and we're not going with the up one. So we're leaning more towards the sideways type of pattern. And if you were in the class last night, and some of you were, there are strategies that you can use to take advantage of this. You just need to know what to do and the right time to do it. So our warning signs, this is pretty much a continuation of where we've been. We're still below those longer term trend signals that may be signaling that we're at a top. And it's going to take a while for that to play out. Seasonally and historically, September is not a good month, but we are possibly coming into a historically good time where the equity put call ratio, it's turning back up. The longer term equity put call ratio is also turning up and looking like it could be starting to roll over, but it's not that convincing yet. The risk on posture is continuing to show some weakness. The cumulative new highs, new lows for the NASDAQ are still showing weakness. We're still above the 2007 level with the 3-month yield, and that was up a little bit in Tuesday's session, so it's not rolling over yet. The parabolic SAR is still negative, and we're dealing with earnings season. On the positive side, we still have seasonality and setups that are in the background. The daily special K chart is positive. The weekly chart is negative. We're still above the downtrend channel upper line. The S&P 500 oscillators are now mixed across the board. The NASDAQ 100, it's positive, but it's starting to show some weakness. And I thought I had changed that. It should be, it's showing a little bit of improvement. The S&P is outperforming utilities, and the Staples to S&P 500 ratio is declining. That often gives support to the S&P, but it's not really happening right now. The Russell, the small caps, and the mid caps are working off of recent golden crosses. Small and mid cap growth has been going sideways, but it's still positive. The financial sector generated a recent golden cross. The Copic curve has also generated a recent buy signal. So our conclusion, we're mixed and not trending. How's that for being decisive? We can say that for the short and intermediate term, where we're still positive in the long term. So thank you. Have a wonderful day. I hope you found this helpful. We'll see what happens with the CPI report and then how the market reacts to that. So have a very good day, and I will talk to you in the next video.